All right, we talked about Tesla bulls, and we're going to meet one in just a moment. In fact, one of the biggest ones on the street. But to preface that, Tesla's wild ride has left many of the analyst community in the dust. Check out where analysts stood just a year ago on this stock. Average price target was roughly $300 a share, just above where shares were trading at the time. Today, the average price target is closer to $500 a share. And that's more than 30% below where the stock closed today after that distinct sell-off. Next guest thinks Tesla has room to run. In fact, she thinks Tesla could hit $15,000 a share within the next 4 years. Let's bring in ARK Invest CEO and founder Cathie Wood. Cathie, welcome. I know $15,000 a share is not your base case.
No.
It's your reach case. What is your base case of where this $700 stock is in 4 years?
Yes, the base case, it's a 5-year target, so the end of 24, it's $7,000. And we've arrived at that price by weighting the probabilities of 10 different scenarios, including bankruptcy, to be honest. So we've tried to be as fair and balanced as we possibly could be, but our confidence level that this stock is heading for $7,000 over the next 5 years is very high.
So you take out your lowest probability scenarios, you take out the ones that you think just aren't going to work, or the highly outlandish ones where everything has to click exactly right. On what bricks is this $7,000 foundation founded? Is it improving margins? Is it lowering the cost of production of the vehicles as they get up to scale, or what?
Yes, there are 3 sources for the increase in our estimate, our estimated price target. One is, as Tesla killers entered the market last year, we expected Tesla's market share to go down from 17% globally, that includes China, to something lower. Instead, it went up to 18%. And the reason it
17% in electric vehicles or in all vehicles?
No, electric vehicles.
Vehicles.
This is global. There are many electric vehicle manufacturers in China. Very low quality, but very. So what we're learning is Tesla is just so far ahead of the pack. And I'm talking about the BMWs, the Mercedes, as far as range and other important metrics when it comes to electric vehicles. Their battery cost is 3 years ahead, 3 to 4 years ahead of any other auto manufacturer in terms of the cost declines. And so every other auto manufacturer will, if they want to be competitive with Tesla, and I'm including BMW and Daimler and all, if they want to be competitive, like for like, they will have to sell their cars at a loss at the same time they're losing their internal combustion engine business. So they have a big problem. So
are you confident enough in their ability to overcome what I would call sort of manufacturing hairballs that have struck them in the past and caused them to miss or delay production targets?
So nothing is in a straight line, you can't promise, but what they did in Shanghai was unbelievable, breaking ground and producing within a year. And I think they're taking those learnings elsewhere. In Germany, outside of Berlin, we've been thinking, okay, that's a setup for bureaucracy. They have been welcomed with open arms because Germany doesn't want to lose the auto industry, right? And they don't want to lose the jobs. So, and now we're hearing potentially about Texas. So we think they're going to surprise on the production side now. It took a lot of trial and error, just like with their Falcon rockets. When they were trying to land them, it was failure, 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 then success, and now they've been successful.
Here are 5 compelling reasons to buy Tesla stock in 2025. The first one is leadership in the electric vehicle market. Tesla remains the global leader in EVs with a strong brand, innovative technology, and a proven track record of delivering high-demand products. By 2025, Tesla's product lineup, including the Cybertruck, Tesla Semi, and potentially a $25,000 compact EV, is expected to drive significant growth. Tesla's focus on vertical integration, for example, battery production in gigafactories, ensures better control over costs and supply chains. The growing EV market, supported by global regulatory efforts to reduce carbon emissions, positions Tesla to capture a significant share of the industry's growth. The next reason is growth in autonomous driving technology. Tesla's advancements in full self-driving and autonomous vehicle technology are expected to be game changers. The potential for Tesla to launch a robotaxi network could revolutionize transportation and create a high-margin recurring revenue stream. Tesla's Dojo supercomputer enhances its AI capabilities, giving it a competitive edge in the race to perfect autonomous driving. Even partial adoption of FSD by Tesla's existing customer base could contribute billions of dollars in annual revenue. Number 3 is diversified revenue streams. Tesla is no longer just a car company. Its diversification into energy storage, solar solutions, and software subscriptions provides multiple growth avenues. Energy storage. Products like the Powerwall, PowerPack, and Megapack cater to the growing demand for renewable energy storage solutions. With increasing adoption of solar energy globally, Tesla's solar roof and solar panels represent a long-term opportunity. Software and services, FSD subscriptions, over-the-air updates, and other Tesla software offerings will generate high-margin, recurring revenue. Reason number 4 is expanding global production. Tesla's gigafactories in Texas, Berlin, and Shanghai, with potential new factories in India and Mexico, are expected to significantly boost production capacity by 2025. Tesla's ability to scale production efficiently positions it to meet growing demand in both established and emerging markets. Increased production capacity will likely reduce per-unit costs, improving profit margins. The 5th reason to buy Tesla stock is strong financial position and innovation. Tesla's ability to innovate and execute has been a hallmark of its success. By 2025, the company's focus on innovation and financial discipline is expected to strengthen further. Tesla's profit margins have consistently outpaced many traditional automakers thanks to its efficient operations and high-margin software sales. Continuous innovation. From battery advancements to renewable energy solutions and new vehicle designs, Tesla's commitment to innovation ensures it stays ahead of competitors. Tesla stock in 2025 presents a strong case for long-term growth investors. Its leadership in EVs, advancements in autonomous driving, diversified revenue streams, global expansion, and commitment to innovation make it a compelling investment. However, as with any investment, consider potential risks like economic headwinds, regulatory challenges, and increasing competition. Diversify your portfolio to mitigate these risks effectively. Tesla has been one of the biggest surprises of 2024. The stock lagged the market for much of the year as the company reported disappointing quarterly results, including sluggish growth and falling profits. Additionally, electric vehicle sales growth has slowed as momentum in the sector seems to be plateauing now that early adopters have already purchased an EV, and EV stocks have struggled in general this year. Through October 23, the stock was down 14% year-to-date, underperforming the S&P 500, which had gained 21% by a wide margin, as the chart below shows. However, since then, the stock has been on fire. The company first impressed investors with its third-quarter earnings report, which showed strong profit growth, and CEO Elon Musk predicted that vehicle production would increase by 20% to 30% in 2025. A significant improvement from flat growth in 2024. Then Tesla soared following the election as Musk's big bet on Trump seemed to pay off. Investors seem to be hopeful that the Trump administration will make it easier for Tesla to roll out its new cybercab, also known as the robotaxi. Tesla is also planning to launch an affordably priced Model Q at under $30,000 in the first half of 2025. As you can see from the chart below, through December 17, the stock is up a whopping 125% in less than 2 months. High expectations are now baked in Tesla. Stock was already expensive before its recent rally, but its valuation now seems to have fully detached from the underlying business. The stock trades at a price-to-earnings ratio of 200, which is much more expensive than any of its Magnificent Seven peers, none of which trade at a PE above 51. At that price, it will be difficult for Tesla to meet expectations as a car maker alone, as the company is already selling nearly 2 million vehicles a year. Those high expectations seem to be based on Musk's own predictions for the company's autonomous vehicle business, as he said that Tesla would be the most valuable company in the world if its robotaxi marketplace takes off. Considering that the Cybercab hasn't yet gone into production and that there are regulatory hurdles for the company to overcome, it's certainly not guaranteed that its driverless cars will replace Uber as Musk has envisioned. How much help will Trump really be? Tesla stock has nearly doubled since the election, and Musk's chummy relationship with Trump is a major reason why. Musk spent hundreds of millions of dollars on Trump's campaign and appeared on stage with him several times. He's also been tapped to run the new Department of Government Efficiency in charge of ferreting out government waste. However, Musk and Trump are unlikely bedfellows in some ways. First, Trump is known to support fossil fuels over green energy, and his administration has already indicated that it will eliminate the $7,500 EV tax credit. Musk has downplayed the effect of such a move, saying it's much worse for EV startups than it is for Tesla, but it's likely to shift some demand for EVs back to traditional combustion vehicles for price-sensitive consumers, which would be a negative for Tesla. The real opportunity for the EV maker is in autonomy, and the Trump administration has also indicated that it would ease rules around self-driving cars and establish a national standard, making it easier for Tesla to roll out the Cybercab, which does not have a steering wheel. Tesla has revealed a new premium Model Y version, first launched in China, which comes with a range of improved features. EV manufacturer Tesla launched a new version of its Model Y in Europe, the US, and Canada on Thursday, after already having introduced it in the Chinese market some weeks earlier. The Model Y is currently Tesla's best-selling vehicle. This new version is an all-wheel drive long-range one, which will set buyers in the U.S. back by $59,990, according to the company's U.S. website. This is a rise of 25% from the previous version, which can be bought for $47,990 in the U.S. The recent crash in Nvidia's stock was partially linked to concerns around DeepSeek, an AI-driven trading strategy or tool. DeepSeek is a platform designed to utilize AI for making high-frequency trades based on market patterns. While Nvidia is heavily involved in the AI sector, particularly with its GPUs being essential for AI development and applications, it's important to differentiate between how AI technologies like DeepSeek impact the market and Nvidia itself. DeepSeek as a tool may have contributed to short-term volatility in Nvidia's stock due to a combination of algorithmic trading behavior and investor reactions. When AI-based trading algorithms, which can amplify market movements, make large-scale adjustments, or respond to market signals, it can exacerbate stock price fluctuations, especially for high-profile companies like Nvidia. While it's not solely DeepSeek causing the drop, it's possible that automated or algorithmic trading strategies, combined with broader market factors such as economic data, interest rates, or sector-specific worries, led to the sharp sell-off in Nvidia's stock.